First of all, Dan, thank you very much for talking to us today. It's great to see you here in London. And let's start talking about the markets. The first question, of course, is about real possibilities of US-China trade wars. As it was suggested by Peter Navarro, President Trump is willing to start negotiations with China regarding the tariff which both countries were going to introduce in the mutual trade. Do you think it's still possible that these negotiations could achieve win-win solutions?
I think there will be a result. And I think it could be close to a win-win. It'll probably be a lot better than it is today. This is an item that the Trump administration had been pushing for throughout the campaign. And what he does do is he moves people to the negotiation table because also of his uncertainty that surrounds him. People don't know how he's going to react. Even his administration, I think, has challenges with that. But in a way, that's a good thing. Because in a way, if you're China, how far are you really going to push him? And if he said, I'm doing certain things and it's going to be a reality, do you want to ignore that? Especially, not so much the steel, but when it comes to IP. That is where the money is, and really, if you look at the big picture, and I think results is going to come out of this, and I think it'll be better for the United States and hopefully better for China because they can build a stronger relationship with the U.S. marketplace.
The market volatility generally is on the rise. Could you please explain why does it happen, and is it an indicator of the long-term tendencies or just the answer to the US-China trade wars?
I have to tell you, Olga, what's interesting about it is we saw the first knee-jerk reaction because that is typical. When I look at fundamentals, I want to know, is it reality or is it the market anticipating a possible action? And what we're seeing here, it's anticipating. When the administration said we're going to put out tariffs, the market immediately reacts to that. That's that knee-jerk reaction. But is there really follow-through? Will that change the economy overnight? No. Are the fundamentals really in China improving? In the US, are they improving? And in Europe? Yes. So that economy is like the big ship in the ocean. It's not going to turn immediately. So my feeling is I'm still very positive on the US marketplace. So volatility? Yes. Are we going to see more? Yes. As people anticipate new items or issues that come up. But it's to be expected, but I think long term, everything is still in place for a strong market.
Amid news on negotiations between US and China, US dollar went up. How could it affect commodity prices expressed in other currencies and consequently in trades?
Well, it's a very good question, and it definitely has an impact. We have a few things at work. If you look at the US economy and the US dollar, the expectation is that people outside the country would want to participate in that strong market. Therefore, it puts upward pressure on the US dollar. That'd be the first expectation. However, other countries are doing well. If you look at China, if you look at Europe, there are some very positive things when it comes to recovery. Japan, Korea, Australia. So is there the same incentive to invest in the United States? That could be debated as well. But let's go back to that principle that people want US dollars because they either want to do trade with the US or because they want to invest in the US marketplace. So I would expect that long term that we would see a stronger US dollar. When it comes to commodity prices, especially in the agricultural area, there are some big challenges there. Because as the US dollar gets stronger, it costs more to buy our soybeans and corn and wheat that we produce in the United States. And plus we have some very good competitors globally that can supply those products. Corn and soybeans would be our friends in Brazil and Argentina can have a big impact on that. So for the farmer, which is such a tough job, for the farmer, for their product, it definitely could have some impact. And that's why it's so critical for them to hedge when they make some final determination of what they're going to plan. So that rocky road, I think, is going to continue.
Of course, being in London, it's impossible to avoid conversation about British pound. After EU and UK negotiations on Brexit and Brexit transit period, pound began its bumpy ride, while now, for some time, it is on the rise. What is your opinion? Can pound continue to climb up?
I think it can, based upon perception. So right now, it seems like things have calmed down, that the market is kind of getting used to the idea of Brexit, for one, and it seems like there has been some accomplishments with negotiations. So I think that creates a certain comfort to the marketplace, and therefore that pound is moving up, and I would expect that to continue. And the economy here is actually not too bad either. So we have some positive things, but you know, Olga, what's going to be interesting is when it becomes reality. When Brexit really occurs, do people have the same optimism, the same comfort level? And my expectation during that period would be people are going to start identifying things that no one can anticipate now, but would be saying, look at that, didn't work, or this is a problem, and that's a natural part of this whole process. But what it will create is uncertainty, doubt in terms of belief, and it'll cause volatility, I believe, in the pound.
Now, how bonds markets react to the news of negotiations between China and US?
Well, I think what we're seeing with the bond market, and that's an interesting point that you're raising, I think it's more connected to our stock market than directly to China-US trade negotiations. What those trade negotiations have done is they created volatility in the stock market, which did cause it to go down in that knee-jerk reaction to it. And what it does for the bond market, it strengthens it. Bond markets will go up because money goes out of the stock market, and bonds are one of the places that it goes to. So I think the reaction, I'm looking at more of a connection to the stock market and the bond market and the US dollar. Those are the variables. And the trade the negotiations do create that volatility, that uncertainty.
And what about gold futures market?
Oh, that's an interesting one too. Now, gold, on the other hand, gold needs an excuse to do something because it is a market that's based upon perception. That if there's uncertainty, if there's high inflation, if there's a weaker dollar, then gold can react to it. If there's uncertainty in the marketplace. Now, if you notice, gold did start to move up when this whole trade issue came up. But if you also noticed, as the stock market started to pull back a little bit, going back up, the gold prices started coming down, just like the bond prices did, because that uncertainty was being taken out of the market. A little bit of a calm before the storm, possibly. So the gold, I think, is behaving normally, and it needs an excuse to do something. And if we're not having one of those variables that we talked about, a sideways move for gold temporarily would be logical.
Thank you, Dan. Thank you very much.
It's always a pleasure.